The altcoin markets are firing off, and you see venture capitals investing into all sorts of projects and getting a tremendous return. And that's why we wanted to create a video about venture capitals, as we are one ourselves, and how we spot the next 100x gem. And in this video, we'll share some stuff that you can use to find those gems yourself. So let's get started. Before we continue with this episode, I would like to ask you for a small favor, which is to subscribe to this YouTube channel, but also to follow me on Instagram. Because right now we are traveling to many conferences and places on this planet to get more partners and to build up our network, to do some cool stuff, which we will be sharing on our social media. But I would highly advise you to follow me on Instagram if you're interested into that, but also if you're following me for the altcoin portfolio and the trading that I do, because on Instagram, I'm going to provide real-time updates on the portfolio in stories, posts, background info, everything is happening. Now, there's also a question that I would like to ask to you, which is, which segment are you the most interested about in the markets? Is that DEXs or stablecoins or AWA? This could be everything, but let me know in the comments beneath, because we are always looking at segments that you guys are interested in, because we want to be a better VC, we want to make better deals and all those things. And as you know, we've got multiple ventures that we're running. We are having a liquid fund that's called MN Fund. We are completely registered with the Dutch regulator. And we have a private venture capital that's called MN Capital, in which we invest into startups that we carefully select and assist to have a potentially positive increase in the chances of success for them. And you probably see some tweets passing by of investments that I've been doing with MN Capital, or that we have been doing, because recently we've invested into Toshi. We've also been investing into the Peak ecosystem in multiple projects. So we invested into Peak itself, and then we invested into projects like Combiner, that is basically connecting deep in with energy. And that's where we put in an allocation into that one. And then it becomes interesting to look at what a VC investor is. It is not as easy as you might think it is. And usually you will see on social media people are saying, how is it possible that a venture capital and not me is making a 20x from a round that I was not able to get into? Well, we're going to talk about that today, because it's a way more trickier than you might think it is. And you could actually be smarter than most of the VC investors that are here. And first of all, the reason that we travel to many events is to get in touch with people in real life. And that's the first step of getting and building a network and reputation in this space. And that's why we have attended conference. We have attended Token 2049 in Singapore. We have also been going to Token in Dubai and Paris Blockchain Week. And there are more conferences on the horizon, with Cebu Live in London, SmartCon, and also Bitcoin Amsterdam popping up, which means that is where you start getting in touch with people that are interesting for you as a venture capital or any of the other entities in our ecosystem. So when we do that, then the first step that we need to discuss is, what is a venture capital? And essentially, a venture capital is, as you can see, a form of private equity and a type of financing that investors provide to startup companies and small businesses that are believed to have long-term growth potential. So we are willing to fund a project or a team or a great idea, and we are happy to assist them in their journey towards success. And in order to do that, we fund them at a certain valuation in a round that is not open for everyone. And that's where you can get all those rounds that we call pre-seed, seed, strategic, Series A, B, or C. And usually the pre-seed round is the earliest round, and that's the lowest valuation, and that's where the first steps are taken. So the actual first funding comes in, and that is where the project starts to build. That's also the most risky period to invest into a project because you have no data, there's no proof that it works, there's no revenue, etc. So let's use an example. And in that case, we use Plasma, which is one of the recent listings that we've seen. Plasma started doing a seed round in October last year, in which they raised 3.5 million. 3.5 million is probably somewhere between the valuation of 30 to 50 million. And then in February of this year, another round was done of 20 million at around a valuation of around 200 million. You might think that that is too much money to spend on a project. However, this is how much you will need to build a strong project and have a runway for 2 to 3 years before teams are going to get their unlocks in which they can keep on funding themselves. Now, those are the rounds that we invest in. We didn't invest in Plasma, but if we look at Plasma right now, we can see that the valuation of Plasma is at 11 billion. So those investors at 50 to 200 million have a tremendous return on their portfolio. A 200 million investor is up more than 50x. And that's great, but you need to realize that those investors are not able to sell anything at this point in time. Most likely they have a contract where they are not able to sell the contract, and they have a cliff investing. What does that mean? A cliff is usually for a year or 2 years that you're not able to unlock your tokens. Then after the year cliff, you have a 1 to 3 year vesting period. And then every week or every month, you will get a small portion of tokens unlocked. Some VC investors are able to sell that entire contract. So let's say you have invested into Plasma. It's currently worth 11 billion. You're like, well, I would like to get liquidity right now. And then they go onto the secondary markets where they sell the contract towards a buyer at a huge discount, but then they get liquidity immediately. But then still the cliff in the vesting remains. Being a VC and getting those deals is all about network and fundamental knowledge. It's less about trading, because if something comes up to you, you need to see whether it's going to have a big use case and whether it's interesting to be investing into that at that point in time. So the moment you're seeing a summary of a project and a team, it's up to you to decide whether you should invest into it. And that's why we are running 2 phases of so-called due diligence. Before we get to them, we are having around 100 projects per week that we get in our so-called top of funnel. And then we are pretty much deciding on team, backing, use case, and background, whether or not it's interesting enough to go to the first phase. And the first phase is when our teams is having calls with a potential project. After these calls, all the data from the project is received and we start doing their research. In the basic research is done. It's basically, is the team strong enough to build the project? What is the use case of the protocol? Is there enough funding? Is there a lead investor or other VCs coming in? And what is the go-to-market strategy? And what are the terms of the deal? In short, one of our team members has provided a write-up on X about Peak, which provides the way of in-depth looking at a protocol that we invest in. Now, as time passes, we get into the second stage, and that's where one of our team members comes in to deep dive into the tokenomics and the token. And the reason we do this is that many projects are great at building tech, but not many of them are great at building tokenomics, because most of the tokenomics that are proposed are actually not good, and that results into a negative charge and also potentially bad investment for ourselves. So some examples of the ones that we know in our public altcoin portfolio is Wormhole, that had such a case. They have great tech, but they had a very steep inflation, and they have a low float, high FTV case that during that period, people were not interested into buying this asset. But if we look at the rounds, we can see that there was a big round with Borderless Capital Coinbase Ventures, and some other big parties at a valuation of 2.5 billion. Then, as you can see, this listed at 12.5 billion and is currently trading at 1, for the simple reason that, as I said, the inflation was super steep and there was no buying pressure capturing so much of the inflation. Now, if this is fully finalized and settled, we get into the final stage where we think that, okay, if we have those valuations, they make sense. That is where I calculate whether or not it's a financially profitable decision to take in order to get a better return than, for instance, holding Bitcoin in the same period of time, and debate and negotiate with the party whether or not the investment is great. So, as I said, in the beginning of this video, I was going to disclose opportunities for you to get in those rounds or to get into opportunities that might yield that 100x gem. And that's what we are going to discuss next. We recently hosted our very first crypto masterclass with OKX, and it was a huge success. We had over 100 people joining us in Amsterdam for me to talk 1 hour about crypto and trading, an AMA, and we had drinks and a chat at the end of the night. We had people driving in from Germany and we had people flying in from the UK. And to be honest, this was something that I really wanted to do for years, and I think that we're going to be doing more of those events in the future. And if you want to be part of those events and want to know it the first, make sure to sign up through OKX in the link in the description beneath, and then you'll be the first to receive updates on all of the upcoming events. Being a VC investor isn't easy. Most of you will see the winners, but that usually equals 100 losses. And we kind of have a benchmark that if we do 100 investments, then 1 to 5 of them are going to be great. And they are basically going to be yielding us the return within the VC. The other 95, some might be break even, some have a small loss, some have a small win, and most of them are basically going to go to zero. And in that case, if you're investing into a project at a certain point in time and there's a big gap between the investment and the TGE, then it might be that the use case might become outdated, and or the team doesn't want to work together anymore, or there are technical issues. There are all sorts of problems that we can see or can happen in between, and that's why a VC is usually looking for a higher return than buying assets in a liquid way. Now, there are two ways for you that you can become a VC investor, but also to get into the same rounds and to have the same opportunities. And the first one is basically through the fact that there are public rounds. So if we look at Plasma, for instance, over here we have the fact that Echo, which is founded by one of the OGs, Kobe, it's a market leader in private investment infrastructure for early stage projects. And you are able to get into this round. You are able to get into a very low valuation because they did a round at 500 million fully diluted network valuation, and they sold 10% of the supply at that valuation, which is 50 million. I'm not saying that all of them are profitable. You need to realize that there's still a lot of risk involved. But a lot of these protocols are looking to get into these public sales or attract the community because they need a community to build the actual platform. And if the community comes in and that is actually going to provide a positive return overall, then everybody is happy and that is great. So that is one way you could look at it, in the sense that this also yielded you a return of 20x if you were able to get into it. And Echo is a great platform, but also CoinList is a great platform with all those launches that they have on there. For instance, Peak was on CoinList, where you were able to get into a round at a lower valuation than the TGE and risk your money by betting on a protocol, but also becoming member of the entire community. The other one in this category is basically seeing fair launches. And one of them is Rekt. We know Rekt Drinks, we know the Rekt community, but they did a fair launch, which basically means that all the tokens are open at the start. The only risk that they have is that they get sniped at the beginning. So there's a sniper attracting all the supply, and then you're basically screwed. But in that way, you and I have the opportunity as a retail investor to get into a protocol at an early stage and then have that 20 or 50x if we had that great eye of spotting that actual asset and investing into that. So those are a few ways that you could look at it. And the second way is that if we look at what currently most VCs are doing, most VCs are actually becoming more liquid and are eager to get into OTC rounds. Now, if we look at, for instance, Wormhole, then I have constantly been saying that if you are an investor into an asset, and we are an investor into an asset as well, not Wormhole, but we have certain protocols in there, then we can trade the volatility to increase our position. And that's something that we call gamma scalping, which means that if the certain asset goes out of the ordinary up, then we are eager to be selling the position and to be buying it back lower to increase the portfolio position that we have and to make the portfolio more capital efficient. The second thing that we do is that we are looking to get into OTC rounds where we fund the team at a discounted value at market price, in which we have a thesis on the protocol. And if we get in at a lower valuation, then that is great. And then also, if we start looking at all those rounds and the current portfolio or the current market, then we can see that most of the assets are not really performing well. So what we see here is that Renzo has been doing a raise for 17 million back in 2024. They have been doing a pre-seed round earlier that period for a value of 22 million FDV. And if we look at the current valuation, then we're quite sure that this raise that happened afterwards is higher than the current FDV. So I think that that raise was done around 200 million. And right now we're at 110 million, which means that a lot of VCs are looking at things like Wormhole and Renzo for a liquid position because it's beneath those rounds that were happening. So Renzo started up quite nicely, but at this point in time, it's acting beneath the seed round investors' valuations. And therefore, you and I get a better opportunity because we have no vesting, no cliff, but these are still technically great projects to look at. So I think those are two key factors to be looking at for portfolio, for your portfolio, and for potential investment opportunities in the market. Today, we've made a slightly different video than normal. This gave you some insights in what we do at the venture and how we get to an investment into the Web3 ecosystem. It's super complex. It can yield a massive return. But in order to have a massive return, you will also have a lot of people losing money by doing these investments. And we also need to provide value adds to improve the success of the project. I hope you have been enjoying the update. I hope you have enjoyed the potential strategies for yourself. Make sure to subscribe to the YouTube channel, and I'll see you again on the next one. Ciao.